In this video, we're going to look at ADP, and that stands for Automatic Data Processing. And this is a provider of HR software and services. And what I do in my videos is I run my own discounted cash flow model. That way I can figure out the real value of the stock and also look at the financial ratios of the company. And I'm going to do this with you the entire video, so it's as if we're doing it together. So let's get started with the model. This company has a market cap of $63.25 billion. And then we're going to get the stock price. And they're trading at 147.17. So that's one share of stock. And now I'm going to get the free cash flows. And the way you value a company or an asset is you have to estimate the future free cash flows, and then you discount that back to today's value. That's exactly what I'm doing in the video. And free cash flow is the cash that's remaining after operating a business minus capital expenditures. Now I'm going to pull the net income off the income statement, and that's the profit and loss for the business. I'm going to put 4 years of that into the model. And then I'm going to pull the revenue, which are just the sales, and throw that into the model. Let's take a quick look at the numbers. It looks pretty good. The free cash flow seems to be rising every year, so that's good. Net income seems pretty good. There's a small drop from 16 to 17, but then it jumps to 18 and jumps again in 19. And then revenue, it looks like it's pretty steady as well. So we should get a good value for the company. Let's get the capital structure so we know what to discount the future cash flows by. The interest expense is $129 million. That's the interest this company pays on its debt. And we'll go to the balance sheet to see how much debt they have. We'll go to the liabilities section. No current debt. They do have $2 billion of long-term debt. That's debt due after 1 year. And they pay 6.5% interest on the debt. Let's get their effective tax rate because interest payments are tax deductible. So the income before tax is $3 billion. And the income tax is $700 million. So they pay 24% in taxes. So the cost of debt is 5%. Now to get the cost of equity, we just need the beta. That's how volatile the stock is relative to the market. And they have a low beta, 0.82. So the stock moves less than the market does. Let's get their current assets, because we need this when we look at the current ratio later. And current assets are assets that can be liquidated and converted into cash within 12 months. And it usually includes cash, accounts receivables, and inventory, possibly other things as well. And that's 34 million. Let's get their current liabilities. This is what the company owes within the next 12 months. And that's 32 million. Let's get the stockholders' equity. That's the value of the company, which is assets minus liabilities, 5.4 billion. And we need their EBIT, earnings before interest and taxes. That's called operating income on the income statement. That's 3 billion. That's how much money the company makes in its regular business, but before it pays interest and taxes. So let's look at a capital structure. So the cost of debt is 5%, and they have 27% debt. And the cost of equity is 8.6%, and they have 73% equity. So the weighted average cost of capital is 7.6%. That's a blend of the cost of debt and the cost of equity. And that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also estimated a terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $58 billion. We divide that by 430 million shares. We get an intrinsic calculated stock price of $135. It's trading at $147, so it's trading at a 9% premium. So it's a sell according to the model. But it's actually pretty close. Let's look at Simply Wall Street to see what they're trading at. They're valuing the stock at $195, so they're valuing it much higher than I am. Let's look at the historical stock price to see where the stock has been moving. It looks like it's been on a pretty good incline for several years. Then in March it dropped a little. It's come back up a little bit, but it's still below its high of probably 170 or so. So it's sitting around the 150s. So the stock price is always based on supply and demand of the market. It's really how much investors are willing to pay for a stock. If a lot of people want to buy a stock and they're willing to pay more, it's going to push the price up. But if less people want to buy the stock and they are not willing to pay as much, it will push the price down. Let's look at their financial ratios. They have a pretty high PE, that's price to stock over earnings per share, 25. I like to see under 15. They also have a fairly high price to sales ratio, 4.3. I like to see under 2.5 for this. That's price to stock over sales per share. They have a pretty high price to book of almost 12. That means investors are willing to pay $12 for $1 of book value. So they're not getting too good of a deal there. Current ratio is fine. It's above 1, so they can cover their current liabilities. A great ROE of 47%. That's income over equity. So they're providing their equity holders a good value. Interest coverage of 23.3, so they can easily cover their interest payments. And debt of only 27%. So the ratios are mediocre, and the stock price, I value it at pretty much what they're trading at. But a lot of investing has to do with how you feel about the company and what you think the future expectations are. The stock market's forward thinking, so people invest to the future. So they don't necessarily invest in how companies are doing today. They invest in how they think the company will do in the future. So that's a hard thing to kind of gauge, is how are other investors looking at this company. So let me know what you think of the video. Thanks for watching.